This episode of Market Talk is brought to you by Growmark FS. Keeping up on the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic grain and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. And joining us now as we recap a busy day in the market trade with the October WASDE report release, we are joined by our good friend Mike Zuzolo with Global Commodity Analytics here today. Mike, good to catch up with you, sir, and I'm sure getting a chance here to take a little bit of a breather and talk with me as it's been a busy day once again with the October WASDE report out today, Mike.
Yeah, one of the most supportive reports for the month of October that I can recall in the last several years, Jesse, and that's led by not only the expected decline in wheat yield and wheat production from the September 30th numbers, but also substantial yield declines when it comes to corn and beans, and also even an acreage decline, a harvested acreage decline as well to boot. So the USDA really gave a lot of supply updates, some partially expected, some not expected at all. I would say from my standpoint, I wasn't shocked to see a bean yield decline, but I was surprised how big it was. I was shocked, however, to see another corn yield decline, given what I'm hearing around the country right now, and given the fact that we're barely 30% harvested in the corn at this point. So I thought they'd keep their powder dry for at least one more month when it came to the corn. And I wasn't surprised that the beans did change because of a little bit more progress in beans versus corn, and many more parts, maybe more spread out around the country, I should say.
Well, Mike, you talk about that soybean yield coming down, and I am very curious what this trade is going to do moving forward. That yield coming in 49.8 bushels per acre. So it's below that psychological 50 level, which, again, I was surprised on. I just wonder what that could do to this trade moving forward.
Yeah, the sentiment of the trade is one thing, but if you look at these hard numbers that I generated for Market Talk Ag today, and I think it really points out all three of them declining. USDA also, and I think rightfully, changed and lowered total demand in all three because of the river level issues and because of the weakened export pace that we continue to see week after week. And so pretty big drop in the corn total demand number, pretty big drop in the wheat total demand number, not as big a drop in the soybeans. However, even with those changes, Jesse, when we look at the average price change from today versus September, we notice wheat went up 20 cents a bushel, corn a nickel a bushel, but soybeans they took from $14.35 down to $14. And so typically and historically, as an analyst, when we see average prices go down, that tends to temper our enthusiasm on wanting to add to positions. That's a general broad brush analysis there. But then if you look at the bottom part of this graphic, we're looking at the world supply demand and just the stocks to use ratios, which I feel are the number one most important thing to look at from month to month to month. And we see that wheat went down 0.9% in stocks to use, still very tight at under 34% stocks left over after demand is factored in. Corn went down substantially. We're now down to 25.6% stocks to use levels. Beans actually went up, however, because we went up to 100.5 million metric tons. That actually created an opportunity to go up in stocks by about 0.24%. So we're at 26.44% now. So that goes back to your question, what does that mean to the trade? Well, if you look at these numbers and you look at where we are in the trade as far as bean corn ratio, bean wheat ratio, and things like that, you could see for a brief period of time, maybe days, you could see the beans unwind short sides of spreads against the wheat, against the corn. But at the end of the week, at the end of, as we go to the end of the month, especially if river levels don't return to normal and we don't improve our shipping line in the barge freight category, I really think it's going to be hard for soybeans to go it alone to the upside, and they're going to need wheat and corn to help them at this stage of the game in the next week or so.
Well, on that topic, Mike, talking about the river levels and thinking about the soybeans a little bit more, I know you are looking at some analysis about China and looking at the demand side. You know, we're not seeing a whole lot of soybeans or corn or wheat for that matter going to China. And it just feels like they're kind of absent from our market right now. What are you seeing, more on this soy side? What's kind of the latest here? I know an ag attaché report. I'll pull that up on the video.
Yeah, this is a really important piece of information going forward, Jesse, because USDA today, if I had to take issue with anything today, it probably was the fact that USDA increased China's soybean imports by 1 million tons and went to 98 million. That doesn't sound like a lot until you look at this report from the Ag Attaché from back in early September, where he actually went from 98 down to 96.5. And if you look at the table here of all the different estimates out there other than official USDA numbers, it's really hard to get above 96.5 for the 22-23 marketing year. And the reason the Post and the Beijing lowered his number by 1.5 million tons was because the Chinese, because of high soybean meal prices, are blending other types of feed ingredients in and reducing their soybean meal consumption in their feed rations. And I don't see that changing anytime soon. So I think what's going to happen here is the trade's going to become more comfortable with the idea that China's growth is okay, China's demand is okay, and their soybean demand is okay. And they're kind of going to whistle past the graveyard because USDA also bumped up the Brazilian crop from last month by 1 million metric tons and raised this upcoming crop year by 3 million tons to 152 million. And so I'm very nervous that the demand side of the equation, specifically from China, because their growth has been lowered so much here in the last couple of weeks, and their hog prices, yes, they're high, but the meal prices are so high it's hard to crush beans into meal. I'm very nervous that the trade is going to assume strong demand in 22-23 for China just because of this report. So I'm still playing defense on the soybeans. And when you add this piece of analysis to the other two things I looked at, I would still say to you, in the longer term and the medium term, soybeans are still the leader to the downside unless we have a serious weather problem start to crop up in Brazil relatively soon.
Well, Mike, I find this interesting as well. And I love just your thoughts on this, thought, because I mentioned the psychological yield number, that 50 mark in beans. Yet we look on the board at the closes of Wednesday, corn still hovering around $7, soybeans still hovering around 14. I find that very interesting, especially at a time historically, we're in the middle of harvest. I mean, these are prices we don't see at harvest time, Mike.
Yeah, and I think to your earlier point about the barge rate and the last update from USDA, and we'll get another one tomorrow on the transportation. Year to date, right now, we've in the corn specifically, we've only shipped out about 154 barges of corn down to the Gulf of Mexico, New Orleans, and that compares to about 308 last year. For year to date numbers. And you add to that the fact that from St. Louis to the Gulf of Mexico, it's about $90.50 a ton for cost of freight at this point. That's over 300%, over 200% more than last year at this time. And so I really do think that the demand side, the USDA cutting demand was proper. I would be expecting another demand cut in November if we didn't see these river levels recover. And that's why the 10-day weather models are up in the top 3 key areas for important fundamental factors for me, Jesse. And that's where that trade psychology comes into play. If we remain dry, I can't imagine why the trade wouldn't start to think that the hard red wheat belt and the lack of moisture is going to create an environment where we're not even going to get the wheat to emerge and sprout. But by the same token, I can't imagine why they won't start thinking we're going to lose even more export demand in the row crops during harvest. And that's going to be psychologically negative and materially negative because this is our time to shine in the export front. So all the things that I looked at before the report really haven't changed much in terms of between the weather, between the wheat report today and the stocks numbers being tight, and between some of the other factors like Ukraine. We've taken the whole Ukraine premium out that we built in the beginning of the week. I really do think we need wheat to lead this market higher. Otherwise, I think there are rallies to sell at this point.
Well, Mike Zuzolo, Global Commodity Analytics, is our guest here today. And Mike, you mentioned wheat being the upside leader, at least you feel that it needs to be. I want to talk about the funds. I want to talk about our old friend, the funds, and against the fundamentals. You sent a couple charts I'll pull up on the video feed as well. But talk to me a little bit more about that idea of why you believe wheat should be the upside leader here, Mike.
Well, it does go back to maybe the funds, the managed money funds specifically, are trapped in the corn market at this point. I mean, why would you want to add too much more corn when you're net short wheat with the 550 million bushel carryover? So this is the corn managed money futures position on the commitment of traders report versus the futures price, which is the red line. And, we're still hovering near the top end of the late 2022 second quarter levels at this point, or mid 2022 second quarter levels at this point, Jesse. And we're not too far away, less than 100,000 contracts, or right around 100,000 contracts from being at the largest position in 2022. And that was led by the wheat market as far as the corn going higher with the wheat. So here we are in the middle of harvest with this drought. In the low river levels, and the market is still in the managed money position, very long corn. And so it would make sense for a time, given the report, that they would want to buy back their beans, sell out of their corn some. But if you really want the corn to go higher and you want it to go back up to that 7.25 level, which I think fundamentally it should be able to do, given the fact that we're at a 1.1 billion bushel carryover at this stage after today's report, I do think you need the wheat, because those wheat funds are net short still. And I think they need to become net long as we get into the winter. And this especially, I would say, goes back to the Ukrainian situation. We just simply don't have enough risk premium in the wheat when it comes to Ukraine, especially given the USDA did not change the Ukrainian or the Russian wheat supply numbers, their production numbers. They did monkey around with the corn number a little bit on Ukraine, but for Russia, they kept it at 91 million on production. Russia earlier this week is at 103. And I would stress that I bet that that's partially some Ukrainian grain mixed in.
Yeah, I would agree with you there. I think that is definitely a great possibility. And just thinking about the issues we have in the wheat market, that stocks number lowest in 15 years in the U.S., and combined with all the geopolitical issues, et cetera, I'm with you. I feel like wheat has to be the upside leader here at some point, Mike. I think it's just a matter now of when the explosions start to kind of come together here, and we get that move back to the upside, Mike. I think that's the thing right now.
Yeah, and just to cap that off, I think the key, and I talked to a guy in the middle of the Kansas wheat belt right now earlier this morning, and he said, "Why isn't wheat rallying? This is crazy." I mean, if you look at the emergence numbers from the report from this week on crop progress, Kansas is still down 10 points versus last year. Only 19% of that crop has emerged at this stage, and it's only going to get worse with a colder, drier forecast in the next 10 days, because that's what we have. And so, Jesse, I really think it goes back to the dollar, and I think that's why the wheat is such a good leader to the overall grain markets, because of the sentiment it picks up from the dollar. We just made a fresh 24-year high against the Japanese yen. That tends to really back away any potential longs in this market. That's the one thing that I can explain to the audience as to why the funds are even net short at this point, is because of that dollar. But we're getting some other fundamentals underneath us now that maybe that dollar means less as we go into the winter time.
Something we'll have to watch very, very closely for sure. Let's talk livestock, Mike. We don't want to lose sight of the protein sector here today. Cattle and hogs, when it was all said and done, had a decent day again on Wednesday. It felt like cattle may be taking its cues from the corn market, which, overall corn kind of just traded either side of unchanged, and settled pretty much right at unchanged on the day Wednesday, Mike.
Yeah, and USDA was pretty kind to the meat sector. I mean, maybe it was a little bit rougher for the pork sector overall, net, but it still looked like to me, between the production figures for 22 and 23, beef and pork, and then include the export figures for beef and pork for those 2 calendar years, per capita consumption stays very high. It did not go down. So these higher prices are not hurting the consumption side of the equation like I've been worrying about now that we're in the fourth quarter. So that's a good piece of news. And by and large, we're holding on to our export market pretty nicely. And so I think if we follow that up with another round of strong export sales on Friday morning, because of the holiday, it's going to be delayed a day. I think if we follow it up with another round of strong export sales, I've been talking that maybe because of the fact that the fat cattle futures have held up so well, maybe we're looking at a cash market that could turn 146, 146.50 by the end of this week. Again, because of the drought and because of the way the futures market almost is kind of signaling that we've got something underneath this cattle market, which again, I think is partially the hog market. We're going to see more pork released from China's domestic reserves as they try and cool their hog prices and pork prices over there at the retail level.
Now, on the cash cattle side, it feels like the cash trade's been waiting for to see what grains would do, was waiting for the WASDE report. Still haven't seen a whole lot of activity as a Wednesday afternoon, but I think about this cattle market and I think about some of the prices I hear. Some areas say Iowa, I'm hearing some pretty, high prices in some of the sale barns there. And I just think about what we're seeing in cash country right now. Feed margins coming up, obviously a big issue. I just wonder what this cash market on the cattle side is going to look like here, in say another month or so, Mike. I know we've been waiting. A lot of folks have been waiting and have been very bullish cattle, and it's yet to explode.
Yeah, and I think this goes back to that consumption issue and my fear that it was going to become more of a buyer's market, that the packers could sit on their hands and not do anything because the consumption was not going to be that strong as we got into this fourth quarter. So far, that has not happened. The high frequency data is still a little shaky, but when you look at the overall mix, and especially when it comes to competing supplies of poultry and pork, and when you factor in what's going on with the avian influenza in Europe, and now it's starting to come back into our country, I think we're more balanced than we have been in the last 3 or 4 weeks, Jesse. So if you're talking about the next month, I think going into the Christmas ham seasonal, it looks a lot better to me than it did maybe 3 or 4 weeks ago, especially given that the belly and cutout markets are starting to firm up as well. So I'm cautiously optimistic on the live cattle market, especially given the fact that we've gotten these big rallies in both the Chinese cash hog prices and also their futures prices, say in the Dalian exchange over in China.
I know as well. You mentioned the dollar, and we did see some inflation data this morning, the PPI numbers, but it felt like the stock market and the overall macro picture kind of just took those numbers in stride. It didn't feel like they were a huge news item today, Mike.
Yeah, that's a really good point. It was a very strong PPI number if you don't look at the exclusion of the food and energy. That core PPI number was right with the trade estimates. Maybe that's what they decided to look at this month, but the overall PPI was up a little bit more than the trade was expecting, and that just keeps the Fed and their pedal on the metal when it comes to raising rates. I've got to believe, though, Jesse, with some of these things that we've been talking about, and then you throw on top of that Ukraine and OPEC Plus and what they did, I've got to think those guys and ladies are sitting around that table right now thinking about this supply-led inflation and how their blunt demand instrument is just not going to get the job done, and they need to back away for a few months to see how things look from an overall perspective. I mean, we're looking at major infrastructure of energy being obliterated at this point because of the Ukraine-Russia war. That's not going to bring energy prices down.
Well, Mike, great analysis and thoughts as always. And before we run out of time and I let you go, anything we missed that you want to mention or anything you want to reiterate here on the show today?
No, if we did, we'll pick it up on a free trial. Go to globalcomresearch.com because there's a lot to talk about and a lot to write about and analyze, and hopefully you pick up a trial. Love to work with you as a subscriber, cash client, or brokerage client, but just know your risk in commodity trading, and it's not for everybody.
Very, very true. That risk is not for everybody. Globalcomresearch.com. That is com with two M's. Globalcomresearch.com is how you can get a free trial and talk with Mike Zuzolo. We appreciate the time and the conversation as always, sir. Have a great rest of your week. We'll talk to you next week.
Thanks, Jesse. Appreciate your interview.
Mike Zuzolo with Global Commodity Analytics, our guest today here on Market Talk. That's going to do it for the show today. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.